So what we're going to do today is I'm just going to teach you. I'm going to teach you more on inducements. I'm going to teach you more on stop horns as well. Remember, that was the main thing that we had based on our the program that we had concerning backtesting. So we're going to still work more on inducements and stop horns. Okay, we're going to work more on inducements and stop horns. And if you remember, in almost all the classes that we have had so far, I've been trying to make you understand how to choose valid inducements, whether to expect and engineer liquidity and stuff like that. Now, always have two scenarios that will happen. You can have a point of interest like this one. Okay, you can have a point of interest like this one, and then you can have a point of interest in this manner. All right. So these two scenarios, they have two different approaches to it. They have two different approaches to it. One of these already has its inducement, the other does not have. So in this case, this one, this one already has his trap. Okay, this one already has his trap, which means you can just expect price to come back to the point of interest, taking out that inducement, and then continue down. But with this one is different. This is where uh we expect to see engineered liquidity. Okay. We expect to see liquidity here engineered, which means that we want to see price about approaching the key level to play some games with our mindsets before finally tagging into our point of interest. In this case, this is what we call the engineered liquidity, right? Sometimes, some people might call it build-up liquidity in the sense that the market can actually come, approach that level, and then manipulate for some time or accumulate for some time. All right, in this case, it's building up liquidity, hence it manipulates to the upside and then finally distributes. So we always have two scenarios. Either we are going to have a direct, either we have direct liquidity or we have engineered liquidity. This is very important. This is very important for you to note. When you have your point of interest, and it is like in the case of engineered liquidity, expect this. If you have your point of interest, which is in the case of direct liquidity, you can expect this as well. Now, sometimes how you get in here also depends, all right? Because sometimes the momentum might be very high, which might scare you out. Sometimes the same here. But at the same point, you have to understand your IOF very well. Okay? You have to understand your IOF very well. Now, understanding your IF means you understand direction coming from the higher time frames. Okay? If you understand direction coming from the higher time frame, you will not be scared to enter this trade. All right? Or simply you can step down to a lower time frame to have your entry. This is a whole strategy that I'm sharing out here. This is a whole strategy I'm sharing out here. If you're able, we think maybe in our next lesson we'll actually talk about good order blocks or good points of interest. Okay, we'll talk about good order blocks and then good points of interest. Now, when you look at this key level here, you will notice that we don't have a reason for price to actually trade above this high. Why is that? Because we noticed that there was already a high that was taken out here based on probably inducement, because I feel like price did this to mitigate something here. So we already had a liquidity grab here before price moved lower to break structure. And in this case, we noticed that it was a single move that went to break that structure before we had its first pullback. And this first pullback is quite far from this point of interest. Hence, we are actually expecting price to give us to engineer a different liquidity for us. All right. Now, if you wanted to use this as your liquidity or your inducement, you would have been tempted to get in around these pullbacks here. Okay. Now, I used to say also that when you have a point of interest and you're scared to get in, because if you're looking at the 4-hour chart, you will feel like price should have stopped haunted this point. Okay, price should have price fill this fair value gap, it can then start moving up, especially seeing how this candle closed. All right, and that can actually, I mean, make you to be scared if you should sell or not, if you sell again or not. But I used to tell you that if you're scared of an entry, what you have to do is get confirmations. And the common confirmation that we have so far is based on model one. Okay, is based on model one price closing below the last bullish candle in that point, in that key level. So, which means that you would have been patient and then you got in here rather. Now, if you get in here, you technically your stop should be above that model one entry confirmation. And then now you can target this sell side liquidity, which is this in this case was about 3.58 R. This is about patience. This is about patience because if you are not patient enough, you wouldn't have been in this trade up to this moment. Remember, this is even the 4-hour chart, and if you are not also convinced about your point, your direction, this would have tricked you in. All right, you would have considered this to be another block, and then consider this to be liquidity. You will notice that price actually reacted to it because this is a very clean order block with a clean inducement. So price knows that smart people are looking at it as well. So it gives you some little hopes and profits. And at the same time, the only thing that you would have done wrong buying here is because you neglected the higher time frame. That's the only issue. Okay, you neglected the higher time frame. If you did not neglect the higher time frame, you would have been in a sell and then even hoping for more lower prices right down to clearing all these lows into this huge inefficiency here that we have here. Okay. Now, you will notice also that let's look for another example. Good. Let's look this one. We have a good point of interest. Why should we consider this point of interest? We have price sweeping above this high. So we already have price. In fact, it swept above the high into another point of interest as well. Okay. So we have a good order block. Now, if you look at this scenario here, we had a break of structure and it was a single move to breaking that structure. All right. And still then price started pulling back. When it pulled back, when it pulled back to this point, we had no technical liquidity build up, right? We had no technical engineered liquidity. We had no technical engineered liquidity. And what happened? Price actually mitigated the point of interest. And I believe that with this mitigation, a lot of people started selling. Believe me, even if I was the one, I would have been tempted to sell as well. But in this case, since we had no engineered liquidity, uh, I would have been more careful. What do I mean is because let me explain this other scenario. I think I gave you only two scenarios here, right? Let's talk about another one. Let's talk about this one of uh, manipulated liquidity. Okay, let's talk about manipulated liquidity. In this case, you have your point of interest. It's very similar to this engineered liquidity. Why? Because price comes back immediately into your point of interest. Okay, price comes back immediately into your point of interest. And what happens here is not technically the same thing that happens here or this one. Okay? What happened here is that price comes directly to your point of interest, gets you tapped in, and then as it starts to move around, to move back down, it knows that everybody is on the trade. Nobody is selling. So those who move their stops quickly back to this point of to the high here, those are the people the market traps. Does something like this, and then it moves down, which is what we have here. So this is an example where remember that the market is always trying to bring that liquidity. Okay, the market is always trying to generate that liquidity. Why is that so important? Because the market need opposite liquidity in the market. Remember, I always emphasize that if this is you selling here and then putting your stops above this high, your stops above this high is simply a buy order. Okay? That's simply a buy order that you have in the market. And what is your buy order implying? You sold something here, you sold something here, and then you want to buy it back here if at all it wants to keep going higher, right? If not, if it goes up and you don't buy it back early enough, you will start to buy it here, which is already very expensive, and that's going to cost you more. Let's say, for example, you sold something at $2. You sold something at $2, but the prices did not drop. The prices went up to $4. Now the prices are at $4. This is already telling you that you are losing money because if you didn't sold and then you sold now at $4, you'll be making more profits. But now what you sold at $2 now is worth $4. So if you don't buy it at $4 and it goes up to $10, and you are to buy it at $10, you are making a huge loss now because you sold at $2 and you are buying it at $10. So technically, that's not the right business to do. Now, I'm just giving this explanation to make you understand that your stop loss above, as you move it to break even, above this high, is going to be the buy order that the market is expecting to see because the market is looking down. You will also notice that before this happened, you would have had the market already did something here. The market already took out the buy orders that were here. So this is already a sponsored move to the downside. So this is a fresh level where the market needs to take out the buy orders as well before it moves down. All right. So in this case, the market stop horns those that got their stops so quickly into break even. Remember, it is very rare that the market will just move so smooth like that without triggering other participants in the market. It's very rare to have it to see it. All right, even if you see there's going to be maybe a lower time frame where that probably happened. Now, in this case, we had price still stop holding this high to move lower. And let's say, for example, that when price came to that point of interest, you were scared and you decided to use more than one. You decided to use more than one like this, and then your stops are the high of the more than one. Now, in this case, the only mistake that you're making here is that this more than one is not healthy enough because we have no stop point. Okay, we have no stop point. We have no clear stop point. Now, you will say that it's mitigating a point of interest. That's not the case. When you have a point of interest, it doesn't still change the fact that there should be a manipulation or a stop point into that point of interest for you to get your number one. All right. If price comes directly to this and then sells off, I told you that it's rare to have it, right? But now what you're looking for is that price should on its way coming up to that point of interest should at least gives you a stop hunt so that you can use your model 1 entry around that level, knowing that there's a stop hunt into a point of interest. Okay, that should be the assignment, or that should be what you should be looking out for. So in this case, if you didn't consider looking at the stop hunt, which this is not a valid one, this is not a valid one. We don't have even, this is not even a swing low, because you can see that price is not even close below this candle. So this was just an accumulation, and price moving higher again. So regardless, sometimes you're going to have these stop losses. Yeah, it's very possible. And when you do, what next you have to do is be patient, and then you get in the right. When price presents another opportunity, you find yourself in, and then you hold price. Now, there is another scenario here, which we have this other block. Okay. Now, this other block, or this situation, is when price uses it's when price use your key level as liquidity. Okay. You can just call it you can use it as key level liquidity. Okay. In this case, you actually have your point of interest like that, and then the market approach your point of interest, and you expect price to react from it. And what does it do? It tries to stop on your point of interest before moving your direction. Also, this is a case of a situation where we don't have a closer inducement or an engineered liquidity. All right. Where price tries to stop hunt your point of interest like we had here. Okay. Now, in most cases, you have in most cases this happens in how do I put it? In most cases, it happens where inducements were not available. All right. So also, let me tell you about something. I think in our last session, I gave you guys I mentioned something about, I talked to you about inducements, right? Which one should choose? I mean, which point of interest to choose based on inducement. Now, in this case, you have a point of interest here, and you have another point of interest here. Which one do you think is going to hold price? Type it on the chat. Let's see. Which one do you think is going to hold price? We have E, and then we have B. Type it on the chat. Which one do you think is going to hold price? A or B? Second. Okay. Daylight says second. Before B. Okay. All right. So you guys said B. Now it's actually B. It's actually B. All right. It's actually B. But even though it is B, it depends on this point of interest. It depends on what this did. Okay. It depends on that. If this if this pullback actually filled a liquidity here, like a kind of a fair value gap, then what is going to happen is that it's going to respect with A. Okay? It's going to respect with A. Why would it respect A? Because the point of interest of A fills the fair value gap, and then we have a close inducement to it. Okay? The market will respect A. But now, another thing is that the distance between the low of A and the point of interest B also matters. If they are close, then price will use A as the inducement to B. But if they are far off, then price would technically just use A as a swing, as a point of interest, and then we'll continue the movement back up. Okay, let me try to look for an example. Okay, let's see if this is gonna work. Now we have this zone here. We have let's say that we have this other block here, right? And then we have this one. If you look closely, it's the same thing. We had a stop point here, validating first point of interest, right? Our first point of interest is validated. Our second is our swell is validated because it also has a stop point, and not just a stop point, it has a stop point also filling out some liquidity. So in this case, you can also see the distance between this and this one is quite large, which means that if price is taking this low in for reasons to come into this point of interest, people that have sell stops, they are going to make a lot of money from it, right? They're going to make a lot of cash. They're going to make a lot of cash from that move, which is not the intentions of a stop hunt in the market. Now, why did price have to react to this one? Because we had an inducement very close to the point of interest. Okay, so if we wanted to, I mean, in this case, if you were like waiting for price to come to this point, you would have missed out on the move. But based on this explanation I've given, you could have now risked to take this trade. Okay, you would have risked to take this trade. Why? What has made this trade so good is the fact that it has a clear inducement, and it's just not just a random inducement. This is really a proper inducement, a swing low, that is a fixed swing low, right? It creates a swing low, try to move back up, and then this actually why I say that this is a strong inducement is because it went up and gave a break of structure. That means that it has succeeded to convince people that this is a valid swing, that this is a valid swing low, which means that people are buying here now, people are buying here and putting their stops below this low. So they are completely convinced that we have a point of interest here. So their stops now are going to be at this point. So if the market is interested in stops, then it takes this, it should continue back up, right? That's why I mentioned that this is a very strong inducement. So this, you should understand the reasons why I gave out this scenario here. Now, also take note that all this kind of trades, they're based on your higher time frame liquidity. Now, let's look at this one. We have a point of interest here, which is our other block. And I want to think that this inducement is a little bit far away from it. All right, I want to believe that this inducement is quite far. And if it is that far, there is still one here, this swing low. It's going to be much clearer on the lower time frame. So if you have used this as your inducement, then that will be good. Your stops would have still been down here, and that will be okay. All right, you can also see that we had a very clear structure break and then that inducement. So in this case, we had inducement even before the break of structure, right? Now, at the same time, if you had neglected this to be an inducement and then also consider this to be too far, you would have been more patient here as well to see if pricing truly wants to take out this low or not. But at the end of the day, we noticed that price did what? A key level uh, attempt of manipulation here. Okay. Price almost took out this low at this point. But now what I'm trying to explain here is that if you had neglected this point of interest, I mean this inducement, and this one as well, although they are very close to this, you would have been expecting at least that, okay, since I don't trust this one and I don't trust this one, I'm going to wait for confirmation. And then waiting for confirmation, what you have here is that price literally stop haunted the first touch of that point of interest. So this is your valid point, your valid total so, which makes this model one entry reliable. Okay, because this is the first mitigation of this point of interest. And what happened? The market has rejected back up. It came back down to take out the low. So we have actually had a key level manipulation. And then this other block now, we can consider it to be a reliable order block to trust or to put our stops below it. Okay. And in that case, we target higher prices. But why would you have been buying in the first place around this area? It's only if we had a higher time frame movement, or we had a higher time frame supporting that idea. That should be the only reason. Now let's look at this point of interest here. I think this should be our last setup. Okay. Now, if you look at this area here, you also notice that our inducement was very close to it, very, very close to the point of interest. Why should we trust this point of interest? Because we see price already took out some liquidity behind. So this is a valid high for us. And if the only reason you can get this wrong is if you do not follow the higher time frame. Okay? When you follow the high time frame, your points of interest and inducements, they become very clean, or they don't stress you at all. Okay, and here maybe you were scared about the entry. You would have been looking for your model one. The last bullish candle that we have in this case, price closing below it validates uh, a reliable order block that you can use, which in this case you might have choose this one. All right, and then you target your sell stops here. Let's see, we have another point of interest here, which is this other block. And this other block, this liquidity was quite a little bit far, but then the market came up, it engineered another one here. Right? It engineered another push, like equal highs around that point. And I think this is not too far from this other block, right? I think it's not that far from that other block. So that is another valid point of interest for you to get an entry from. Now we had a key level here. All right, we had a key level, and now you would have asked maybe this person or this point here, you would have been expecting price to come up right up to this entry before selling. Now, based on what I explained later in the scenario where we have the A and the B, you would know that you would have your reasons to expect price to react to this one. Because when you look at this point of interest, the only inducement that we have here is this high. And you can see that it's quite far from that point of interest. All right, it's quite far. And what does this point of interest make so that we can trust it? It has filled liquidity here, which is this fair value gap. And you can also consider this area to be like kind of a breaker. All right, so this point of interest have actually filled a liquidity and then also stop haunted some equal highs here. If I go to the line chart, you're going to see that we had a valid swing high here, which got stop haunted right before price moved down. So this was a valid zone to consider reaction from it in the cases where we had the inducement closer to it. All right, so I don't know what I'm going to do. I don't know. I was expecting to subscribe to this, but these guys, they declined to use a prepaid card. So, I don't know. Tell me on the comment that if this, what we are doing is still helping you to learn. All right. If it's helping you to learn, then we can do more of it. Though I'm feeling discouraged because I wanted us to play price, and regardless, we're still learning, right? We're still learning. So that will be it for today's session.